Okay, a very good evening to Inche Ashamuddin bin Yaakob, and I and my group members will discuss about a problem case. Our group members are uh, Nurul Najia binti Asmi, Nur Afifa binti Razali, Nik Asri Nadia binti Nik Muhammad Nazri, and I, Vaishnavi Murugan, will discuss about the problem case. So the problem case one is about Samuel and Paul partners. Okay, A. Did either Samuel or Paul violate the rule of professional conduct concerning independence and explain? Okay. In a law of subsection 112 in relation to MIA, Paul violate the rule of professional conduct because a professional accountant must adhere to the concept of objectivity, which states that accountant must not jeopardize in professional or commercial judgment due to prejudice, conflict of interest, or undue influence from others. So in this case of Samuel and Paul, Samuel had a financial stake and interest in Chomel. This he refused to hire an independent auditor and instead he recommended his partner Paul to act as Chomel's auditor. A professional accountant may not engage in a professional activity if a circumstance and connection has undue impact on the accountant professional judgment regarding the activity. So Samuel can also influence Paul to make an unjust choice when auditing, since he has a financial interest in Chomel. When an auditor permits their familiarity with a client to compromise their independence, this is also known as a familiarity trait. So in this case, at the end, um, he render an unqualified opinion in Chomel. This demonstrates Paul have a lack of independence and he is inability to function as Chomel auditor. So for B, can you explain about was any other rule of professional conduct violated? Can you explain, Najiha?
Okay, for the A, another professional conduct rule was broken, and that was rule of honesty. A professional accountant shall comply with the principle of integrity, which requires an accountant to be straightforward and honest in all professional and business relationships. Despite being swayed by Samuel, he could not break the law because he gave an unqualified opinion and conclusion. And assuming that Chomel's financial statement includes serious misrepresentation or fraud, Paul may have offered an unqualified opinion to Chomel because Samuel is his partner and to avoid misunderstanding. You know all this time that Paul acted unethically in his professional capacity. At last, we know Paul has engaged in unethical professional behavior, which is honesty. Next. For the C, I will explain if any rules of professional conduct were violate, verify this disciplinary action. Would you deem appropriate if any rule of professional conduct were violated? First and foremost, if the auditor broke any professional conduct standards such as integrity or honesty, objectivity or confidentiality, their license should be suspended to prevent them from repeating the same mistake. Not all ethics violations are treated equally. It's not only breaching laws and regulation and of course damage to our reputation, So we should obey the rules of professional behavior and complete self-discipline in our lifestyle. Next, can you explain about problem case 2, Nur Hafifah?
Okay, so I will explain about problem case 2. Okay, I will clarify the ethical implication of accepting the engagement. So the term of ethical implication is refer to potential consequences of a particular action and decision, integrity, impartiality, professional competence, and due care, confidentiality, professional behavior, and technical standard are the core ethical principles that apply to all service that professional accountant in public practice deliver. Accepting a new customer connection by professional accountant in public practice may risk compliance with the key principle. Questionable concerns related with the client may pose a danger to integrity or professional behavior. This implies that if a firm is contacted to take a new customer, it should study the possible client, its owner, and its business operation to see whether there are any concern about the potential client integrity that pose an unacceptable risk. These investigations are often carried out as part of a know your client or customer due diligence approach, which is also carried out to comply with anti-money laundering legislation. After accepting client, the company should examine the appropriateness of the specific assignment it has been requested to complete. And obviously, this issue must be analysed in the context of possible involvement, and they must be properly documented. Different form of prospective engagement will result in different issues that need to be considered. If the business required to audit a huge group of firms with activities in many countries, for example, resourcing the audit should be the most concerning issue. In order for an engagement to be profitable for the company, it must be beneficial commercially. However, the company must ensure that commercial concerns do not take precedence over other factors to be addressed. So for question B, what do you think? Nik Azri?
Okay, I will explain about B. Assume that you accepted the engagement and prepare the 30 September statements after accepting your unaudited 30 September financial report. So the learning outcomes include an explanation of the factors to consider and procedures to follow before accepting a new client, a new engagement for an existing client, or consenting to the terms of any new engagement. It or non-audit or insurance engagement. Acceptance decision are critical since new client and or engagement can compromise objectivity or expose the firm to risk, both of which must be carefully considered. One of the ongoing debates in the profession is whether non-audit services should be provided to audit client at all. Furthermore, when presented with a prospective new audit engagement, or auditing. Before accepting a new client relationship, a professional accountant in public practice should consider whether acceptance would present any danger to issue to compliance with the fundamental principle according to IFAC code. This means that when a firm is conducted to take on a new customer, it should study the possible client, its owner, and its business activity to see if the
if there are any issues about the potential client's integrity that pose an unacceptable risk. After accepting a client, the firm should examine the suitability of the specific assignment it has been asked to complete. There are maybe ethical concerns that make the involvement unacceptable risk, particularly if objectivity is at risk, if members of the audit company own stock in the client or have family ties to client. There could be a trick. If hazards are found, the client may not have to be turned down because protection may be able to minimize the risk to acceptable level. So that's all for me. Next. Okay, thank you.